It was another positive day on the stock market. In fact, the S&P 500 hit a new 3-month high. We also saw the Russell 2000 hit a new all-time high, but the downside of that was the Russell 2000 then turned tail and actually finished lower on the day, whereas the other three major indices in the United States did close in the green. In today's trade application, I want to focus a little bit more on those defensive areas of the market again. We did have one defensive stock that we've talked about a number of times in this video, leading the stock market higher here today, and that kind of set the tone for the market all day long. I'm going to be focusing again on the healthcare space in today's trade application. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's July 10th, 2018. If you're new, first of all, welcome aboard. We're grateful to have you in our audience today. Remember, you can always subscribe to our YouTube channel. Also, check out our description area where you can sign up for our daily email distribution list, which would entitle you to the various stocks hitting new bullish and bearish or overbought, oversold clusters within the S&P 500. In addition to YouTube, we're also heavy users of Twitter. Make sure you're following me there. My handle is @BrandonVanZee, all one word. We certainly appreciate your likes and your retweets of these Market Outlook tweets on Twitter as well, if you get value out of them and you want us to continue doing them on a regular basis. In addition to Twitter, we're also on Facebook. You can join our group by jotting down that web address you see on the logo in front of you. All right, with that, let's go ahead and dive into our analysis of the markets here. As you can see, I've got the S&P 500 on a chart pulled up in front of us. And as I mentioned before, we actually hit new 3-month highs here today in the S&P 500. So that is viewed obviously as a bullish sign, all things considered. And so you can see our nice little high label right there touching today's candle. Now, as a reminder, for those of you that are premium members of Market Scholars, you can follow along with David and I's presentations by always notating what chart we're on in the upper left-hand corner here. This is chart 4A to get us started here. So S&P 500 did close up by almost 10 points on the day. That was our 4th straight up day, so that's a promising sign as well. There's 1, 2, 3, 4. Not only that, but we have that dark green background color of the chart on the S&P 500 right now, as opposed to that light green right there. What that's telling us is that we now have a strongly bullish posture, not just a bullish posture. That happens when the green line, that intermediate term line that we focus on with the market forecast indicator down below, is bullish and rising above the 50 level on the chart, kind of that midpoint right there. So that's a strong sign, in addition to the fact that we also have a green moving average tip right now as well. And what that signifies is price is above a rising moving average. Again, generally a bullish feeling towards that setup right there. Other things of note, we did have that red line fall here today, but it did not fall into that lower reversal zone, so we didn't quite get that, that bullish intermediate confirmation signal that does crop up every now and again. But it is worth noting that the orange line right here, this is the market sentiment line. Remember, we overlay that on top of the market forecast indicator with this particular think script here, and it's showing it in kind of that dotted format right there. We don't talk a lot about that market sentiment, but it is kind of one of those longer term indicators that gives you a little bit additional confirmation as well. And it is bullish at this current level as well. Let's take a peek at what's going on with the other indices out there. Let's go over to chart 4B now. This will show us what's going on with the Dow, the NASDAQ, and the Russell 2000 in addition to the S&P 500. And as you can see, we've got bullish postures across the board. The Dow remains with a weekly bullish posture. So again, we've got that light green color background right there as opposed to the dark green down below here on the Russell, the NASDAQ, and as I mentioned before, the S&P 500. Now notice right here that the Russell 2000 hit a new, not only yearly high, like our little label says here. Remember, that will happen automatically on this chart series here. Whenever this particular security hits a new yearly high, that label will appear. Some of you might be wondering, well, why isn't that happening up here with the S&P 500? Well, remember, this is a yearly high label. What we're looking at on these charts is only 3 months in length. So if you ever wanted to go out further in time to kind of identify that for yourself, let's just go over here to a 1-year daily chart on the S&P 500. And you can see that we've still got a ways to go to get to this level that we were trading at back in January. On the other hand, we come down here, we look at the Russell 2000, we take a look at a 1-year daily chart there, and this is indeed the new yearly high, in fact, all-time high for the Russell 2000. But as I mentioned before, there is one fly in the ointment there in that we did actually end up closing lower on the Russell 2000. We don't like to see that. We want to see more follow through when we see a big kind of breakout new highs type of a day, and we did not experience that, unfortunately, today with the Russell 2000 closing down about 0.5% when it was all said and done. You'll also notice that the NASDAQ over here closed just a hair below its all-time high. That was hit back here on June 20th. Now, this candle isn't perfect, but some of you will recognize that as looking very similar to a hanging man candle. And remember, that occurs when you're up at a resistance zone. That same shape of a candle is similar to a hammer that you guys are familiar with as well. But remember, a hammer happens at support, hanging man happens at resistance. I think more people than not would probably categorize this as closer to resistance. So we don't know until tomorrow whether that candle is actually confirmed or not, but just keep that in the back of your mind. You don't want to see that kind of slowing down right when that selling pressure hit a couple weeks back on the NASDAQ there. The Dow actually closed near the highs of the session, so maybe a little bit of life coming back to some of those multinational companies that are out there as well. I mentioned in the intro that there was one stock that was really leading the way today. In fact, let me do this. I'm going to come over to Twitter for just a brief second. Remember, you can follow me at Brandon Van Z. As we scroll a little bit lower here, notice that every morning at 9 a.m. Eastern time, I produce this graphic called the 9 at 9. And this morning, the best stock on the board to the upside was actually Pepsi. And so that's a little bit rare. Remember, Pepsi's kind of a boring company, one of those dividend aristocrat companies that you'll hear me talk about, meaning they've raised their dividends for over 25 years in a row. But every now and again, they can have an exciting day as well. And that's actually where we found ourselves in the market. You'll notice here on our Market Watch tab that if we break down the sectors, we actually have the staples as our #1 sector here today. The financials were in the doghouse down there at the bottom. For those of you that were in my dividend growth investing class here earlier today, remember that's a premium service at Market Scholars, you'll know we concentrated on some beaten up financial stocks to add to our dividend growth investing portfolio today. So make sure you're checking out that recording if you didn't catch it live. But what I wanted to do is come in here and show you some of those stocks that were moving within those leading and lagging spaces, starting with staples. And indeed, there is Pepsi up there at the top. Now notice Pepsi ended up closing up on the day by 4.7%. Remember, pre-market, it was only up right there about 2.55%. So that means that Pepsi actually gathered in more momentum as the day went along. Now you guys will recall that have been watching me in these videos for some time that it was a few months ago I said Pepsi was kind of a secret dividend play that not a lot of people were talking about. And what I was referencing at that time was the fact that Pepsi is one of the only companies that I know of that announces their dividend hike 1 quarter prior to actually doing it. So they announced they were going to be raising their dividend back in February, but they wouldn't be raising it until June. Now, Pepsi does that every year. They're kind of known as the oddball from that perspective. What was different about this time around and why I constantly brought it to you guys, not only here, but in my live classes as well, is that the consumer staples were getting blitzed earlier this year. Many of them had exceptional yield. So we had a combination of the rest of the investing world not knowing that Pepsi had raised its dividends, because remember, the financial institutions that report yield back to you when you look it up, they're going to be looking at current yield, not yield that's going to be happening in 2 months or 3 months or 4 months or whenever it is going to be in advance. So Pepsi was unique in that we have a consistent dividend raiser that's on the aristocrat list. They're not going to renege on their situation or their statement that they're going to raise their dividend. So when they announce a 15% dividend increase like they did back in February, all of us dividend growth investors should be changing our mindset, understanding that that is the new rate going forward, even though it's going to take another quarter to get there. So that's why I was spending that time with you guys on that at that time. Well, it's great to see finally, fast forward to where we're at today, Pepsi, which was below $100 per share just a couple of months ago, is now back up to $112, almost 113 bucks. It not only led the staples today, it led the entire S&P 500. It was up 4.77%. So we love to see that. On the downside, let's take a peek at what's going on with the financials. They were the worst performer on the day. Let me see if I can find them here. There we are. And let's see who were the laggards from the financials perspective. Down on the bottom here, we did have Bright House Financial down about 2.68%. We had Charles Schwab down about 1.52%. Let's go ahead and take a peek back at some of these charts again. And since we're on the topic of those sectors, let's do our sectors 12 grid here. And so as we pull up our sectors 12 grid, I'm sure most of you are catching exactly what my eye is catching immediately. And that was the whole point of us developing the script to look as it does, which is we should all identify within a split second that every single sector in the market right now has a bullish posture. Now, that doesn't guarantee anything about the future, but it does kind of go and show you how nice it is to have access to these exclusive scripts that are available to Market Scholars Premium members, because just like that, I knew without even having to do any further investigation that according to the market forecast intermediate term posture, they were all bullish. We know that because the background colors are green. Now, there are different ways for you to kind of distinguish one chart versus another. And that's what we have to do when all of the charts are telling us bullish signals. What I would do in a case like this is kind of concentrate on what charts have the trends that look sustainable or attractive. You know, if I look at something like the industrials down here, I'm not overly blown away with the way that that trend looks. Now, there may be some excellent values out there, I'm sure that there are, but for a trend or a momentum-based trader, that chart has a lot of work to do for us to get excited about it. So the fact that the intermediate term line is rising here and giving us a bullish posture still doesn't defeat the fact that the chart is kind of chop and slop sideways. We do have other charts that look better. In fact, the S&P 500 itself looks better, but there are some reasonable looking charts out there. I mentioned when I was doing the video a couple days ago that I liked the bounce that discretionary was making, so that continues to hold, although it's up at a resistance area, so we'll want to see how it handles that resistance area. Some of the other charts that are hanging in there okay, healthcare. And that is where we're going to concentrate our trade application example here a little bit later today, but notice healthcare continues to make a move. In fact, several days in a row of upside action in healthcare there. A lot of money flowing into that area. Now, not to be outdone, we find a lot of those other defensive areas along with healthcare down in the bottom rung here also shaping up chart-wise. You can see here that we've got the consumer staples up yet again today. Mentioned that because of the Pepsi news was largely the reason behind that big move in the staples right there. So they're getting awfully close to breaking out on a 3-month basis. We already have telecom breaking out on a 3-month basis. Now be aware this particular product, IYZ, it goes beyond the S&P 500. All the other sector ETFs you see on the charts in front of you are only S&P 500 companies, but remember telecom's a little bit weird. There's only 3 telecom stocks in the entire S&P 500, so there's not really a sector ETF that tracks just 3 stocks. So this IYZ goes outside of that fund family, and it does include small and mid-cap companies as well, but it's still a pretty good proxy as far as what's going on with telecom, and that's a nice breakout in telecom right there as well, as you can see. Utilities had been a star performer. They fell back pretty strongly yesterday, but then they rallied strongly again today. So we were up about 0.95% there on the utilities, and real estate also sold off yesterday, had a rally back to some degree. It was only 0.5% today to the upside, but they didn't fall nearly as badly as the utilities did yesterday. But point being, that bottom rung there with our defensive characteristics types of sectors out there are the ones that are holding up a little bit better. Now remember, you can look at this a slightly different way with our customized chart setups as well. If you're a premium member of Market Scholars, you can come over here to chart, let's see if I can find it. There it is, chart 4H. And this will give you a kind of a line graph view with different starting points. This starting point that is set up by default is the 1 year time period. So over the past year, we still have technology leading the way just purely from a price performance perspective. We also have the discretionary and the energy stocks doing well over the past year. Now, speaking of sectors, let's go back over to the internet briefly here. I wanted to pull up my sector selector. Now, as a reminder, for those of you that are premium members of Market Scholars, you're going to have access to my sector selector each and every week. For the rest of you that are just free subscribers, you'll get bits and pieces of it here and there. You just won't have consistent access to it. So remember, the sector selector itself has already been posted on the blog, and remember, I'll update that every likely Friday night. But there are two pieces to it. The piece that most people will see, the outsiders, the freebies out there, you're going to see probably the top half. But remember, there is a bottom half of this graphic that has a lot more detail as far as how to pick different stocks based off of growth, income, and value characteristics, stocks hitting new highs, stocks hitting new lows, etc., etc. But for the time being in this free presentation right here, let's at least identify what sort of rotations have been taking place within the sectors here recently. And one thing I wanted to notate was notice that week over week, so from the last week of June to the first week of July, we did have the top three all advance. We don't see that a whole lot, but all three of them, real estate, utilities, and healthcare, all moved up one level from where they were the prior week. Remember, all three of those would be considered more defensive-oriented and kind of interest rate sensitive, almost bond-like proxies in some cases. And so it kind of gives you a temperature of the market right now that is kind of a little bit more interested in a little bit risk-off as far as where they're taking their equity exposure. On the downside, it's worth noting that the financial space fell into last place. Now notice that telecom has been rising, but it's got a lot of work to do because it was kind of stuck there at the bottom quite a bit. And remember that I track that sector strength using 10 different categories, which are listed on that bottom graphic down there, but include a whole bunch of things. A lot of things like money flow and CCI, rate of change, 3-month percentages, 52-week high percentages, etc., etc. So it's a nice all-encompassing type of a tool where the various strength ratings can confirm one another and get more accurate results there as well. So knowing that healthcare did rise from the number 4 slot up to the number 3 slot, let's go ahead and talk about our trade example here for the day. So I'm going to come back over here to the Thinkorswim platform, and I'm going to pull up just, let's just do chart 4A, back to the regular market forecast chart here. And I'm going to pull up Medtronic here. Medtronic, obviously part of that healthcare space, maybe not as popular of a company these days as it was during the dot-com bubble when it was more of a growth stock, but it's kind of transitioned to be more of a mature company as the years have gone along. Of course, they do have a long history. They were one of the key companies behind the production of the pacemaker all those decades ago, but Medtronic is now a dividend aristocrat company. They have been for a few years at this point. So similar to Pepsi, they've raised their dividends for more than 25 years in a row or more and belong to the S&P 500. Well, you'll notice that they've kind of been just tracking sideways here recently. You know, they had this nice breakout over at this time period at the beginning of May, went up at a very rapid rate, and then kind of topped out on this candle right here around their last earnings announcement on May 24th. That's another thing I wanted to notate about this. Remember that we're getting into earnings season right now. Companies usually report earnings 4 times per year, as long as they're here in the United States and they're keeping up with their filings and everything. And so we can assume that their earnings announcement will be around August 24th, you know, 3 months after this most recent one that they had. That's important in this conversation because when you guys are trading options out there, you'll know it can be a little bit difficult to find candidates to trade if you are somebody that does not like to trade options through an earnings announcement. Medtronic is one of those that's a little bit off cycle with their earnings announcement, so it would allow us to trade some of those options contracts out in August without having to trade it through an earnings announcement. So just be aware of that. Well, Medtronic went sideways for quite a few weeks and months there. In fact, it went to a point where it was starting to drift down and give us some of those bearish postures. That's why we have those pink and those dark pink backgrounds right there for a while. But you'll notice what's happened here over the last 4 days. We've seen a rally in the stock price itself. We're now back up above a rising moving average, which is why that moving average is now green. And we now have that dark green shaded background as well, telling us that we do indeed have a strongly bullish posture at this point. Now, we have a strongly bullish posture, but we still have a set of eyes that we can look at a chart with and say, yeah, it's strongly bullish posture, but is this the most robust chart on planet Earth? The answer is probably no. It could turn into it for all we know, but at this time, we still see a stock that's kind of stuck in more of a sideways trend, although we appreciate the fact that it's been up for the last several days. So what I thought we would do today is do a trade that would be known somewhat as a bullish trade, but not aggressively bullish. Again, we're not breaking out to new highs. We haven't gone up above 88.65 that we hit back here on May 24th. So we don't want to get too aggressive in a situation like this. So one of the strategies that I teach here at Market Scholars, I teach it every Monday night. So it would have been last night we talked about covered calls. Covered calls and selling naked puts is that particular class. We don't own Medtronic at this point, so it's kind of hard to explain the covered call concept here in this particular market outlook video, but we can do what's known as a buy right. I generally don't like that. I would prefer covered calls, but obviously in an educational setting like this where we don't own Medtronic already, it's kind of hard to teach it. So what we're going to do is what's known as a buy right, and what that means is we're going to be buying the stock and selling the call at the exact same time to kind of emulate the covered call experience per se. So what we're going to do is we're going to come over here to the trade tab. And I've got the August weekly contracts with 31 days until expiration pulled up right here, as you can see. These are the ones that expire the week of August 10th. So again, remember that this would allow us to not have to trade through an earnings announcement, which will be a more difficult task right now for the vast majority of other stocks out there. So I've got those weekly contracts up. Now, one thing to note, weekly contracts are less liquid more times than not than the monthly contracts. So for those of you that desire extreme liquidity, this is probably not going to be the best trade for you. Remember, in a covered call type of a trade like this where we're only selling one single leg, the liquidity is not as essential for us as if you were doing iron condors or something that required multiple legs, just the nature of things. So I'm willing to go forward with it even though we're not going to see extreme pools of liquidity in this situation. So with that, what I decided to do is pick out the $88.50 right here, the $88.50 call. Now you'll notice that particular call with that weekly contract is going for right around $1. The bid at the close today was 98 cents. The ask was $1.03. And so I would assume as long as the markets don't go haywire overnight that we would get filled somewhere around $1 on that particular trade idea. So that means for those of you that are newer to the idea, when you're selling a covered call, you're basically selling away your upside potential. So you don't want to practice this type of mentality on a stock that you think is going to go ballistic to the upside. You know, in a case of a stock going sideways, like the way that Medtronic is right now, maybe a slight tilt higher, it still can be an impactful trade. What you're basically doing when you're selling a covered call is you're saying, okay, I own 100 shares of stock. I'm willing to sell it at a price that the way that we would set it up is higher than where it's currently trading. So in this case, $88.50. So you're saying, okay, Mr. or Mrs. Broker, I'm willing to sell my stock that's trading at $87.39 right now for $88.50 if it gets there in the next 31 days. In exchange for me being willing to do that, you have to give me something in return, and what they're going to give you is a premium. That premium is going to be about $1. So in other words, you could take that dollar, add it to the $88.50 strike price to come up with a total of $89.50. That's your true break even in that particular trade. So that's what we're going to implement here tonight. And again, since we don't already own this company, it's hard for me to show you exactly how to do a covered call. So we're going to do things a little different where we're going to kind of artificially create the covered call in what's known as a buy right. So I'm going to right click on the bid or the ask right there in paper money. And I'm going to come up here to buy covered stock right there. And I'm going to go ahead and just left click, a normal click on that. That loads up our trade down below. Now notice what's happening here. On the top line, it's selling one contract of the $88.50 call That's the weekly contract ending the week of August 10th. And at the same time, we're going to buy 100 shares of stock. 100 shares of stock right there. And then the net effect of those two things is 86.39. So another way to kind of think about this is notice that the stock's price is $87.39. I mean, you can go out there and buy 100 shares of it yourself without doing anything with the options world, but you'd pay $87.39. Down here, it's saying you're paying $86.39, exactly $1 off. And as you can imagine, where that $1 came from is what I mentioned before, the $1 in credit that you're going to take in to start that trade. So you're going to take in a premium of $1 here, and your broker's basically going to say, yeah, for you to pay for your transaction in a buy right or a covered stock situation like we have pulled up right here, they're basically going to take that credit and subtract it from the price that you would pay normally for the stock. So it's another way to kind of think about buying it with a bit of a discount, I guess would be one way to think about this. So let's go ahead and fire that off, confirm and send, and we'll see if we can get filled on that first thing in the morning. All right, well, I want to thank you for joining me here today. Fun day in the markets as things are pretty rosy for the most part here. And it's a lot better than what we saw about a month or so ago when things were getting a little bit hairy. We've got a little bit of a rebound here in July, which is nice to see. And so go ahead and make sure that you're following the bullish side of the market right now. Remember, all 4 of our indices in the United States are suggesting a bullish posture at this point. So with that, I want to wish you all the best with your trades and your investments. David will be back with you tomorrow, and I'll be back with you on Thursday. Have a great night, everybody. Take care. Bye-bye.